Namaskar, hello and welcome friends to Finavision, your one-stop solution for CFA exams. My name is Shushmit Aditya Mukherjee. I'm an educator and an investment research analyst, and this video is a short excerpt from the full class series for CFA Level 3 curriculum. Hope you enjoyed this video. Let's get started.
Analysts can sometimes be biased in their methods. Now, those biases can be majorly of two kinds. One is data mining bias. Let's say an analyst is trying to create a quant model which will predict the stock prices, and it has 100 variables in them. Now it may so happen out of these 100 variables, 10 of them actually do not have a reasonable relationship with the stock prices. They are just there because some data mining biases happen, which means the values themselves show some relations. Maybe the values apparently show some relation, and the analyst has gone on finding out every factor that had some numeric relationship with them, but there is no logical relationship perhaps. Fundamentally, maybe there are no relationships, but still the values, if you take the values together, they seem to have some relationship. And the analyst has gone on analyzing different factors till he or she has found out 100 variables, and obviously has ended up with 10 variables which do not have any logical or reasonable relationship with the price, although numerically they may seem to have some relationship, right? This is called data mining bias. Then time period bias. We have attended this before also. This is related very much to the regime and the market scenarios, assessment of the market scenarios. Let's say you are trying to create a market projection based on recovery phase, but the phase is actually expansion phase. So you are going to make mistakes probably, right? Or let's say you combine a high interest rate regime with a low interest rate regime and try to analyze both the markets together in a single database. There also chances are errors will be made. So this is time period bias. And one word you have to remember here is regime, or another word you can remember here is non-stationarity, right? This is time period bias. So these are analysis related biases. Now, because we are talking about biases, we will understand the correlations later, and we'll talk about other kind of bias which is called the psychological biases. Anchoring bias. Anchoring bias is basically sticking to your first set of conclusions or first set of interpretations. What do we mean by it? Let's say an analyst made a conclusion on the markets that it is an expansion phase market. Right now an expansion phase is going on. And he or she made this interpretation based on three factors: the data on profits, the data on GDP, and the non-performing asset data. These three factors were only included here, right? And the conclusion was this is an expansion phase. But then some other analyst suggested this analyst that you also take into account the data like the change in interest rates, the employment rates, the inflation data, the geopolitical scenario, etc. etc. These factors you also incorporate in your analysis and then create your expectation or conclusions, right? Anchoring bias means this analyst is not able to incorporate it in the proportion that is required. This analyst is very much anchored to the previous conclusion. So the analyst makes a conclusion previously that the market growth rate would be 20% in the next 1 year. After adding these factors, he or she concludes that it's going to be 15%. Growth will be there, it will be 15%, not 20%. So he or she is not able to understand that this can actually be a peak scenario which can lead to a contraction scenario. He or she is not able to figure that out because there is anchoring bias. Anchoring bias means your first set of hypothesis, your first set of analysis, you are just anchored to it. So anchoring bias means anchored to the first. Here let me write the word first. Anchoring means first information or first conclusion or first hypothesis that the analyst has or that the individual has, he or she is just biased towards that, not willing to make changes to the first assumption. Now, then comes status quo bias. Status quo bias means you don't want to change. The conclusions may have to be changed based on recent events. Status quo bias means change is painful. Change makes one sad. This is what status quo bias means. Let's say a quant analyst created a model based on 500 variables. Now, some other analyst or some supervisor comes and says that these 500 variables are not accurate. only 300 of them are accurate, and you have to incorporate 400 more variables which are different. 400 more variables, mathematical variables, which are different than the 200 that you have incorporated. So get rid of the 200 out of this and add these 400. Now this is a huge change that the analyst needs to make. And if he or she doesn't make this change even after the supervisor saying so, then there is a status quo bias. Right? Another example of status quo bias can be bias towards recent events. So let's say in the last year, the market has grown 20%, and your conclusion is this year also, that is the next 1 year also, the growth is going to be 20%. But it might be that the market is in the cusp of change in the cycles. Maybe the peak is turning into contraction cycle, or maybe the recovery is turning into an expansion cycle. Both these changes are difficult to assume if you have status quo bias. So two things related to status quo, two words have to be remembered. One is change is painful, and second is recent events are more important. These two things combined together form the status quo bias. Now we come to confirmation bias. What do you mean by confirmation bias? Let's say an investor starting investing during 2022, and all he or she has seen is upward movement of the markets. Now it is 2025, and the market scenarios have changed. The interest rates are signaling it, the geopoliticals are signaling it, the unemployment rates are signaling it, maybe the NPA rates are also signaling it, the supply demand equations are signaling it. But this investor has only seen from 2022 till 2024 whatever has happened, right? And whenever somebody tries to put in the contrarian probability that the markets may have reached the peaks, then the investor goes back to the initial information which confirms the investor that this is an expansion market, right? Now what can the investor look into? The investor can look into last 3 years historical performance. This information alone, if the investor sticks to, then he or she can keep going on with the conclusion that this is an expansion market, right? So here we have a confirmation bias. What is happening here? Investor has a belief. The word is very important. Belief. And he or she is not willing to see data which contradicts the belief. He or she is not willing to contradict the data which he or she is not willing to even look at the data which contradicts this belief. He or she is too much attached to the belief, right? This is called confirmation bias. The one word you have to remember for confirmation bias is belief or conclusion. Let's say we can also call it conclusion. Already conclusion is made. Whatever analysis we are doing is basically to confirm the conclusion, right? Conclusion is already made. We are just going to look at the data which confirms this conclusion. Now this is a great way to remain biased, and this is called confirmation bias. Then we'll talk about overconfidence bias. What is overconfidence bias? Now overconfidence bias is being overly confident on the judgment of one's own analysis. Let's say there is an analyst who has made great numbers in the last 10 years, right? Which is great. Now, the last 10 years, there were certain market scenarios. From 2015 to 2025, there were certain market scenarios, and the analyst has performed brilliantly in those times, which is great. But the next 10 years, things are quite different. The technology levels are different, the interest rates are different, the geopolitical scenarios are different. Now, if the analyst is not willing to incorporate changes or look at new things to learn, for example, what are the new changes in technology happening? What are the new geopolitical equations happening? What are the new interest rate scenarios that may impact the markets? All these new learnings, if the analyst is not going to learn. Now, if this analyst is overconfident that whatever judgments the analyst is making is going to be 100% foolproof. Now, this is called overconfidence bias. Here, what is happening is two kinds of things are happening. One is known unknowns are not being analyzed. known unknowns means the analyst knows that there is change in the AI landscape, there is change in the technology landscape, there is change in the geopolitical landscape, there is change in the interest rate landscape. These things the analyst is not willing to learn that much because he or she has done brilliantly in the last 10 years. Their learning appetite has reduced and their confidence has grown maybe beyond the point it is necessary, right? This is called overconfidence bias, means you are not willing to analyze and reassess the known unknowns. Then there is unknown unknowns. There is unknown unknowns, right? We kind of know that how AI can impact the employment, right? How AI can impact the employment rates. But we do not know many other impacts which can implicate from AIs, right? We know how they will impact employment. We know that they will impact employment. We know that they will impact how we do things. We know how they will impact automation and all these things. But we do not know overall how many ways AI can impact us, right? How many ways AI can be used. This is called unknown unknowns. We do not even know what we don't know. What are the other factors that we have to know? We do not have the questions with us. Forget about the answers. Now, these things are also not being analyzed. These two things are very important for an analyst or for any person to keep on learning. Now, if somebody is less willing to learn and more confident on their own judgment based on whatever their previous performance, their existing knowledge, experience or whatever, they are willing to learn less. This means they have overconfidence. They are not willing to admit that they can be wrong. They are not willing to admit that they can be wrong. Not admit to others, that is different thing. They are not willing to admit to themselves that they can be wrong. So this is called overconfidence bias. Then comes prudence bias. Let's say it is 2025 and a research analyst is making an analysis of the markets, and he or she decides and he or she concludes that the markets may correct up to 40 or 50% in the next 1.5 years. Let's say the analyst makes this. Now he or she has to share it with their supervisors, with their clients, etc., etc., right? Now all of them have invested money. Now he or she does not want to freak all of them, right? He or she does not want to freak all of them. He or she wants to create normalcy as it is. Now what she does is, she goes back to her model, changes the parameters or changes the inputs or the model itself or whatever, and comes up with a new conclusion that this year the growth is going to be 5%. Now look at this. Her original analysis said that the degrowth will be 50% or 40% or whatever. There will be degrowth, negative growth. And in the report, she modifies it just to sound normal. She modifies it and says that the growth, not the degrowth, the growth will be there and it will be positive 5%. So this kind of activity falls under the category of prudence bias. You want to look sane basically. You want to look sane or normal or regular. You do not want to ruffle the feathers of somebody or make somebody panic or make somebody freak out, although your analysis is saying that some freaky event is coming, right? The reverse can also be true. Let's say your analysis says the growth will be 50%. This year the growth will be 50%. But recently the markets have gone through a crash. They have crashed maybe 40-50%. So you want to sound normal, you reduce it, you tone it down and say the market growth will be only 10%. You tone it down from 50% to 10%. This is also prudence bias. So both ways it is true. Now we talk about availability bias. Let's say the first time you invested in stock markets was 2006. You invested in stock markets in 2006. And by 2008, your portfolio went down 50%. Your portfolio went down 50%. So in 2 years, your portfolio went down 50%. And the previous highs of 2006 were reached in 2010, let's say. In 2010, the previous highs were reached. Now, you have a very different idea of the stock markets. Let's say somebody else invested in the markets in 2012. And till 2018, he or she remained in the markets. He or she has a very different idea about the markets. Another example is, let's say somebody invested in the stock markets for the first time in 2022 and remained in the markets till 2024. Now he or she has a very different idea about the markets, right? Let's say the first case is investor A. Second and third cases are investor B and C. Now B and C have a different kind of impression about the markets, and A has a very different kind of impression about the markets. Now if this impression is the dominant factor whenever they are investing in the markets, then they have availability bias. That is, whatever has impacted them much more, for investor A it was the stock market crash which impacted him or her. For B and C it was the stock market expansion which impacted them. So if A thinks that stock market is a bad place and you should not invest in it and your money can go down the drain, there is 50% chance or 80% chance of it, then A is having availability bias. That is, the information which impacted A the most has become the universal idea for A. Although generally speaking, stock markets have done very well over the longer periods of time. Let's say from 2000 till 2020 or 2024, stock markets have done exceedingly well, right? So A is not very appropriate when if he or she says that there is a 50% chance of losing money. There is 50% or 80% chance that you will lose 50% of your money. A is not appropriate in that calculation. Similarly, if B or C thinks that market corrections are a myth and they generally tend to not happen, then B or C are also having availability bias. Their own impression or the experiences that they had during their investment period are overly biased or overly influencing their decision making, right? Availability bias means things that have impacted more. Impact. Whatever events have impacted the investor more or the entity more is more important. This is a bias because you have to look at the entire data, you have to look at the contrary data also. Also, one other factor can be easy recall. Easy recall. Obviously for A, the easy recall is the 2007 crash. For B and C, the easy recall is the market expansion during their investment period, right? So easy recall can be another factor. Impact and easy recall. These two are the words to remember if you are trying to understand availability bias. Prudence bias means toning down. Toning down analysis to normal numbers, quote unquote normal numbers, right? To not look freaky or to not freak out somebody else. This is prudence bias. So key words you have to remember here. Prudence bias means you are desperate to be seen as a normal person. Availability bias means you are impressed by certain events and you are overemphasizing them when doing analysis. They are easy to recall, they have impacted you more, so you overemphasize them when you take decisions. This is availability bias. Now we'll move into the next section where we'll talk about model and model uncertainty. So what do we mean by a model?
The link to the full class video is given in the description below. Please check that out. Thank you so much friends for being with me till the end of this video. If you enjoyed this video, please like the video and subscribe to the channel for more such classes. Share your feedback in the comment section below and share this video with a friend who may find this helpful. For enrollment to practical application courses, internships and CFA curriculum classes, check the description below. Till then, keep watching Finnovision. See you in the next class.